All right. Well, we have 203 today, and I think it's a good opportunity to get started. Just a reminder, I will be doing some polling question. I want this webinar to be as interactive as possible. So if you haven't had an opportunity, the folks that are logging in, we'll be doing polling through Slido. You can use the QR code at the bottom left of this screen, or you can go use your browser and go to slido.com and use the code 4100174. Just another reminder for that. We encourage participation, but wanted to welcome the participants that have joined thus far. We are extremely excited to have this opportunity to discuss the 2024 risk survey results. I want to thank all of you all for taking time out of your busy schedules to join us today. We have a really good topic to share with you and some good information to share with you today. For those of you who do not know me, my name is Triandis Luke. I work on our national accounts team. We manage a portfolio of the 27 largest financial institutions in the country. We take a team approach to managing those relationships, and we are very proactive in trying to understand some of the hot topics and making sure that we're doing our due diligence in managing the relationship and understanding their needs and really providing excellent service, customer service. And I'll be your moderator today. We have two other participants on the line, but I'll give them opportunity to introduce themselves after going through the agenda for you today. But before going through the agenda, I want to discuss the purpose of the call. One of the things we hear a lot from our customers is their desire and want to learn more from their peers. And I think the survey and the results that we'll share with you today does just that. It gives you as a financial institution an opportunity to compare and contrast the information that we've gathered from your peers. One of the good things about the survey is we've had the opportunity to poll 230 of your peers. They've participated in the survey, and we feel like we have a really good diverse perspective. And what we hope is that the information that we share with you today will give you an opportunity to kind of gauge where your financial institution, your organization fits, maybe where you're performing well, and maybe where there are opportunities for improvement. I would be remiss if I didn't take the opportunity to thank the folks that have participated and shared their insights and have really played a major role in helping us get this information together. We certainly couldn't do this without all of you. So walking through the agenda real quick, what we'll do after introduction is we'll do a study or overview of the study. We'll pass it over to Rob, and Rob will share some highlights in regards to the fraud experience and discuss some attempts and losses. Transitioning over to financial institution risk and share some highlights from there. We'll transition and pass it over to Stacy, our subject matter expert, and give her the opportunity to discuss our fraud classifier model and what we're doing to kind of help the industry better define and classify risks. Then we'll take some time and talk about some best practices from an FRFS perspective. And last but not least, we'll take an opportunity just to review some questions and provide some answers. So do a Q&A for you. So I think it's a good opportunity to Stacy and give her a brief opportunity to introduce herself. So Stacy, if you can come off mute and introduce yourself and pass it to Rob.
Sure, absolutely. So good afternoon, everyone. I'm Stacy Shassoff, and thanks Triandos and Rob for having me. So I am part of the secure payments team here at the Federal Reserve Financial Services. And what our team does is work with the industry to understand what challenges they're facing really from a fraud and security perspective and how we might be able to help with our unique position as the Federal Reserve. So we do a lot of working with the industry. Like I said, we do a lot of education with the industry around different types of fraud and fraud trends, and you know, Fraud Classifier was developed by our team, which I will go into in a little bit. But again, really looking at help ensure the safety and security of the U.S. payment system. And Rob, I will pass it over to you.
Thank you, Stacy. Thanks, Triandos. My name is Rob Williams. I have 25 years in Federal Reserve Financial Service. and had the pleasure of serving financial institutions across the spectrum from bearer instruments to instant payments. I've served in several roles in product management, marketing, and analytics through the years. I have the pleasure of working with a talented team in the Market Intelligence and Insight Group in support of product marketing and sales functions across FRFS. I sponsored this study for the past couple of years. On occasion, we'll be asking polling questions, so please, when you see the QR code and the web on the slide, please be sure to give us your feedback. We want to learn from you in this presentation as well. So let's go ahead and get started. So we were encouraged. The industry has been so willing to engage with us with this annual survey. We're hearing regularly from a cross-section of institutions sharing their experience and perspective on these facets of risk management. We will highlight today operational risk concerns with a concentration on fraud. This tracking study focuses on the perspective of senior leaders responsible for risk management in their organization. The survey focuses on higher level market forces impacting their payment business, payment network risk trends, and institutional priorities setting direction for the organizations. The result we will share with you today represents a cross-section of banks, credit unions, and asset sizes with over 220 institutions per year participating in the survey. The cross-representation of participants is laid out for you here on this slide. With that, let's talk about some of the results. Financial institutions were asked by payment rail if fraud was attempted and whether fraud resulted in losses. In Czech, 52% of respondents said yes, fraud was attempted, and 27% said they experienced losses. In non-bank payment apps, 34% of respondents said fraud was attempted and 15% had losses. In ACH, 22% of financial institutions said fraud was attempted and 11 saw losses. Digging in a bit deeper, let's look at responses regarding debit card. 67% of institutions saw fraud attempted and 46% had losses. As you can see from the graph, the year-over-year percentages are relatively stable for debit, with 1% decline for attempts and 2% increase for losses. The difference between the attempt and the loss numbers gives us a sense of how effective the industry is mitigating fraud for that rail. So if losses are growing at a faster rate than attempts year over year, financial institutions are struggling to mitigate that loss. We heard three key insights in this information from risk leaders as we consider the year-over-year trends. First, over half of respondents saw attempted fraud in Czech increasing from 45 to 52%. However, those experiencing loss grew at a faster rate, suggesting FIs are seeing more fraud and are less effective at mitigating the losses from a year ago. Next, let's look at non-bank payment apps. In non-bank payment apps, 34% of the financial institutions experienced fraud attempts and a significant increase from 26 in the preceding year. Losses increased as well, but not at the same rate, suggesting FIs are either more effectively mitigating the loss or they are assigning the loss to payment rails used to settle transactions like ACH or debit. Finally, what we see in ACH is interesting. ACH saw a year-over-year minor decrease in attempts at 1%, but it saw a significant 6% increase in the number of FIs with losses. This suggests multiple organizations are struggling with mitigating losses in ACH. If you're experiencing this today, keep an eye on ACH credits. In the recent AFP fraud study, corporate treasurers said they saw 47% of business email compromised payments moving through ACH, which is the first time ACH has exceeded wire in this particular study.
Rob, I think it's a good opportunity to interject and share a customer verbatim quote in reference to non-bank payment app fraud in regards to some of the information you just shared. There's a quote here: a lot of our operational risks are coming from consumer adoption of fintech apps. Oftentimes, our customer has difficulty filing a dispute via their account portal, and it is almost impossible to file a dispute via the phone. So certainly this is something that is relevant to the information that you just shared. So I think this is a good opportunity for those who are logged into Slido for another Slido polling question. This one will be in regards to non-bank payment fraud. So let me get the question. So the polling question relates to non-bank payment app fraud. So from your experience with non-bank payment fraud, I'm curious to knowing how frequently does your organization absorb the loss? So if you have time in Slido, if you can input your answers, we look forward to seeing what the results are. So Rob, I'll pass it over to you as the folks participate in Slido.
That's great, Janos. I'm very interested in seeing what the results are on that question. All right, moving on to our next findings. Financial institutions were asked by Payment Rail the portion of losses they wrote off in the past 12 months. Respondents said on average check was 31% of their loss expense in the past 12 months. Respondents saw an average 10% of loss expense written off in ACH. In debit, the average expense write-off was 35%. I want to point out to you the big story on this slide, which is check losses. In this survey result, we saw check on average at 31% of fraud loss expense over the past 12 months. Some of you may say that isn't too surprising given the level of check fraud we have seen in the past 2 years. What jumped out at me was that the loss levels are near parity with debit card. I think it's reasonable to expect a high level of debit card expense given the payment rail was designed with a risk-based revenue structure. Check, on the other hand, was not designed to support loss expenses through revenue. So these are hard losses for the industry in a declining payment rail. It is an area where the industry is going to need to come together and coordinate to combat the problem. There does seem to be some progress as ABA and other associations like ICBA are beginning to call for more cooperation. We were talking earlier about ACH in the preceding slide. Personally, I was surprised by these results in that ACH is a very stable legacy payment rail. I don't recall ACH losses being much of a challenge, with one exception, the broad adoption of web and tel debit origination. The most recent innovation is same-day ACH. The acceleration of same-day credit could be a source for higher than expected losses, though our data doesn't explore that topic. I haven't seen any numbers to suggest that ACH returns are increasing and ACH credit returns are rare. The network relies on return reporting as the main method for monitoring fraud. If credits were the source of those losses, returns will be an ineffective tool for monitoring the risk. This feels to me like an important area to watch in your organization. Thinking about ways you can leverage what your peers share here, there is an apparent opportunity with this information, and I want to be sure you don't miss it. Earlier, we were talking about how stable debit is year over year, and I think that holds true for expense losses as well. The number can be more readily tracked and lends itself to a potential rough metric for you to leverage this information and benchmark your own expenses with the other payment rails. Consideration of expenses associated with fraud would be incomplete without considering the cost of case management in the recovery of fraudulent losses. The poll question for this slide is taking us in that direction. Think about when your organization is working exception or fraud cases with other institutions in wire and ACH. What do you estimate your cost savings would be from efficiencies with the ubiquitous secure communications digital network? So again, use Slido to respond to the polling question. There's a QR code on the slide to help you, and you can go online with the website and entry number that you see on the slide here. Next survey question, we asked institutions to take a higher level look at their organization and consider pressures impacting their institution's risk profile. Given a list of potential influences, we asked if they were impactful and whether persistent or increasing. This graph only shows the persistent and increasing responses. 71% of respondents said strategic risk was impactful, persistent, or increasing. 57% said financial risk was impactful and either persistent or increasing, with a year-over-year increase of 17%. 35% said mule account activity was impactful, while synthetic identity accounts grew year-over-year by 7 percentage points. There are several interesting responses, like the growth of strategic risk, the year-over-year growth of financial risk, and growth in macroeconomic pressure. However, given the theme of this webinar and limited time, I want to focus on the mule and synthetic account results. In the year-over-year mule account survey results, we saw growth of 9% for financials with increasing impact. We saw something similar with some synthetic ID accounts, as persistent and increasing grew by 7%. Mule and synthetic accounts are the financial infrastructure fraudsters use to cash in on scams. Without these accounts and this infrastructure, scams would begin to dry up as their funding gets cut off. There are clear signs the industry is taking this to heart. Some of those efforts are apparent in the design of both instant payment rails. Both instant services have core integration for credit push with the capacity to communicate to the originator of the transaction acceptance without posting to the receiver for additional compliance review. NACHA is also working through their ACH rules to both encourage and require RDFIs to be less passive in their acceptance of ACH credit transactions. New NACHA rules have a similar concept in mind, with new terminology, false pretense, that enables RDFIs to return a credit transaction due to a suspect account.
Rob, if I can interject again, I think you shared some really interesting information in regards to mule accounts, and there was a customer verbatim quote that I want to point out to the audience. You see below, but I'll read it for you. People are falling for internet scams on social media daily. Some are turning themselves into money mules. And I think it's a good time and I will be curious to hearing feedback from the audience with another polling question. Curious if you can take an opportunity to log into Slido, and we want to know what's your organization's risk exposure to mule and synthetic accounts. If you could answer that question in Slido, we greatly appreciate it. So what I'll do now, once as folks are taking that polling question, is pass it over to our subject matter expert, Stacy, and give her an opportunity to talk about the work we're doing in regards to fraud classifier.
Thank you. So what you see up on the screen is our fraud classifier model. And just a little background for those who may not be familiar with it. So fraud classifier was launched in June of 2020. And what it offers is a holistic picture to help organizations better understand the magnitude of payments fraud. This was developed by a work group that our team led. And again, this was in response to industry feedback that there wasn't necessarily consistent classification being used to classify fraud. So like I said, the work group was put together, and this was rolled out and developed as hoping to offer a more holistic view into what fraud looks like. So each of the classifications is supported by definitions that allow for consistent application across the industry. So if you go to our website and you download the model, there are examples out there, there's definitions, and there's tips on what questions to ask in order to get answers to help you follow the path to classify fraud. So again, some of the key features of the classifier model: it enables classification independent of payment type. So that was something that was super important to the group, was we wanted to be able to use the same classification regardless of what rail the transaction traveled on. It's also independent of channel. So again, no matter what channel was used, this model can be implemented for the payment. It differentiates between authorized and unauthorized parties. So these those two terms are used quite a bit now, especially, when we're talking about scams and authorized push payments. But when this came out, 4 years ago, unauthorized was more of the focus, and actually there was a lot of conversation on whether we should include authorized or not. But as you can see, it focuses on, authorized or unauthorized. So we have a polling question that we will start with, and then I'll talk about some of the survey results. So the fraud service providers are integrating the fraud classifier model into the case management system and reporting and analytics solutions. But how else do you think the industry is using fraud classifier models? So would love to hear feedback on that, if you're using it. The next slide, if you can see up on the screen, talks about the common fraud categories. And again, there were 3 that really stood out. So the authorized party was manipulated. That's when the authorized party is deceived into initiating the payment. So that would be the typical scam that you would think about. The unauthorized party modified account information. Again, this is, for example, a forged endorsement. And then the unauthorized party misused the account information. So again, the unauthorized party doesn't have control of the account, but is able to obtain payment instrument or enough information to initiate a payment without the knowledge of the authorized party. So those, again, came in pretty close with the survey, and are super interesting to see that. If we look over to the other side around the specific fraud events, product and services was up there. So again, this is a situation where there's a transfer of funds, but the product was not received, or perhaps what was received was not what was advertised. So again, examples of this are travel scams, lottery scams, puppy scams, a lot of this that we're hearing about in the headlines. So it ties directly back to what folks who answered the question are seeing. Compromised credentials was another big one. So again, that would be a login of the account that's intended for the authorized party, but again, it's an unauthorized party who actually is logging in. And then impersonation. Again, this one you likely are seeing in the headlines as well, so consistent with what came up in the feedback. But, a person or organization who doesn't have authorized credentials but has enough information to authenticate as the authorized party. So, nothing out of the ordinary in the survey, but again, I think it's interesting to see it all pulled together and see where the trends are. So Rob, I will pass it, or I'm sorry, Trios, I think I'm passing it back to you. Trando.
Well, thank you, Stacy. So you had an opportunity to hear from Rob, talked about fraud losses and trends, and Stacy did an excellent job walking you through how we're helping the industry better classify and define fraud with our fraud classifier model. I want to just take a few minutes and walk you through how we're helping our customers from a Federal Reserve perspective complement some of the services you have in place today to mitigate fraud, and what we're doing in our part to kind of help you manage those key areas. One of the things for us, we think of our risk management services in 3 areas. First area is risk mitigation. How can we use the information that we have, provide that data to you to kind of help you mitigate and reduce exposure to fraud. Number 2 is from an information services standpoint, how can we play our part as an operator and get that information out to you soon to allow you to make decisions and again, reduce your exposure to fraud. And number 3 is from a dispute resolution. I think you all know that from time to time with payments, you're going to run into situations to where payments were sent in an area, they were potentially fraudulent, and there are situations to where you need to deal bank to bank and handle those and provide solutions for your end user and your customers. So we try to think of it in those 3 ways, and we're trying to identify ways to where we can differentiate ourselves as the Federal Reserve Bank. One of the things we're not looking to do is pill and replace and provide services that are already available to you, within the industry. We're looking to how can we use the information that we have to better serve and complement and add more value to what you already have in place. So here is just a list of some of the services that our product team, in my opinion, has done a phenomenal job and just helping our customers better manage risk. It's broken up in a couple of different ways. If you look at it from a prevention and investigation standpoint, one of the key products stands out is our Fed Detect Duplicate Treasury Check Notifier service. And this service is actually really unique to the Federal Reserve Bank because we're the Treasury for, or we're the bank for the Treasury. And one of the things that we've seen is a large increase in the number of those treasury related payments, especially after the pandemic, when you start seeing those EIP payments and some of those other benefit payments, as well as just the growth, overall growth of some of those treasury related payments. So what we do with this product is help our customers identify duplicates, and we provide that information to you so you can really go and do your due diligence and see if there's, if this is an honest mistake, and or if it's potentially fraudulent. So I think that information is extremely valuable, and giving that to you early on to kind of help you manage that risk. One of the newer products in the continuation and expansion of Fed Detect, as we moved over onto the ACH front, Rob talked a lot about the mule accounts, and I know you all are familiar with the new notch rule and financial institutions having a mandate and having the ability to manage those micropayments and understanding if there's any anomalies out there where there could be potentially fraudulent, someone out there just pinging accounts to see if they're open. So we have a product specific for that we use machine learning. We're able to look over your historical history and provide those type situations where there are some anomalies and be able to provide that information to you to where, we've done the work for you, and then you can go, we provide the information, you can go and do further due diligence. So a lot of work in regards to that. And one of the things I think we're committed to is how can we use this technology and some of this functionality to expand across the enterprise, so we can provide that, from an enterprise perspective. But that's a little bit from the prevention and investigation standpoint. One of the things that, from an investigation standpoint, that I would like to highlight is our Fed Transaction Analyzer on our wholesale side and our Fed Payments Insights on our retail side, ACH side. These products and services allow you the ability to go in and develop, if you want to develop trends and get a more historical look at some of the work in the past. And just at a matter of a few clicks of a button, we provide all of that information to you. It's very user friendly. It allows you access to data, at the file level. You can even get a little bit more refined and get to the per item level as well from an ACH perspective. But those we've heard from customers are extremely valuable, help save a lot of time and energy, and just provide that information a lot more efficient. Last but not least, we talked a little bit about managing those exceptions, and we have two products that we have out there today that we've heard from the industry that are extremely user friendly and help kind of streamline that process. One of the things we have a lot of work going on is on the Fed ACH front, our exception resolution service, to where we allow you to better manage some of those exceptions with ACH, and I'm pretty sure you all are aware of how that network has continued to grow, and it is continuing to grow. So we have a service called Exception Resolution Service to help you provide a easy, more user-friendly way to manage those exceptions. And we've heard really positive feedback on the check adjustment side as well. So those are just a few products and services that I wanted to highlight. And in the midst of time, I will move on to our next slide. But I did want to just highlight some of those services that we're committed to thus far. So I think it's a good opportunity now, Rob and Stacy, for a Q&A. So let's move on to the discussion part of the meeting. I have a couple questions. Rob, if I can, I would like to start off with you, if that's okay.
Sure.
So one of the things that our audience is interested in knowing is what key risk or fraud insights did you see for credit unions, community banks, and regional banks? And maybe wanted to see if you can share some information in regards to some of the research that you've become accustomed to and kind of share that with the audience.
Yeah, to be honest, as I think about the segments that you laid out there, I think a lot about like the end users that they serve, and probably to some degree where their products and services are. So on the credit union front, really relying on consumers, the focus is really going to be about draft fraud and scams, credit push scams. I think focusing on the credit push side, I noticed from the survey that the vast majority of the folks who responded there, they do mule scam on account open, and then periodically. So that's an important area for them to think about, like what opportunities do I have to focus on the transaction activity coming in, and what risk might I have in receiving these credits and identifying where I have exposure to mule accounts, or I may have account holders who have effectively sold their account over to a mule, and they may not be aware. I really like the quote that you called out. I've heard that from several organizations that end users are doing that kind of thing. I heard that a lot from places like that serve college towns and things like that, with students who may not be as sophisticated financially and are online a lot. Maybe they're engaged with social media a lot. So I think if for the credit unions, I would focus in those two spaces. For community banks, I think that's pretty similar. We hear a lot from community banks about the impact of social media today, how they're struggling, one, with how to leverage it effectively, both for their relationship with their customers and what their customers are seeing about their own organization from other people, as well as the same kind of problem where their customers are being influenced by social media scams like Facebook scams. So I think that's a key area. Check fraud, of course, is also another area in this space. Using services that give you as early of notification as possible is critical. I think mule accounts too is a significant risk for this particular segment, given that they may have more disconnected technology or not as well integrated technology, and that may be a challenge that they're facing. So thinking about services that watch inbound credits and being connected into some of these new NACHA rules changes and applying those NACHA rule changes to their to their account holders is critical. I think the other side of that too is finding ways to accelerate or identify issues that they have with checks. That's one of the challenges that we frequently hear, is that a community bank will get a fraudulent check or a counterfeit check deposited. They extend the funds to the depositor, but they find out like 5 days later that it was a counterfeit check when they compare that check to the to the normal check stock of that particular account holder. So that's an area that community banks really need to focus on and be vigilant. Regional banks, I think on their front, similar kinds of problems, but the new facet of ACH and accounts payable credit scams. That's seeing the fraudsters understand how to leverage ACH more effectively, and seeing them know how to leverage some of those same BEC techniques that they used in Wire in ACH. I think speaks both to, one, ACH is being used more often, and two, fintechs and some of these other kinds of organizations who may not have the level of risk management that a banker might provide in services that they give. I think that's an area that the bank should watch too. And I think analytics is key to And you've already mentioned some of those services and where they apply. So hopefully that, helped address the questions there.
Certainly does, Rob. I appreciate that. A lot of good information. So, Rob, I guess staying with you, another question that we got from the audience is if you can share what unique insights did you see from the data, specifically for checks, ACH, funds, mobile, and instant payments. You mentioned a little bit in your earlier statement, but I'm just curious if you have any more information you can share with the group today.
Yeah, I think some of the key best practices that we saw is remembering, fraud or risk management. Pundits frequently speak about multi-layering approaches, using point services. Fraud in general as a management problem can frequently be very whack-a-mole like in nature. So sometimes you need point solutions to try to address problems where that's happening. I would say try to get as close to the event as you can, looking at that information, watching your trends, looking for opportunities to benchmark, communicating or engaging with other peers, using information like this as much as you can to help understand where you're starting to get out of tolerance. I think on the credit push, Zelle, some of those other applications, definitely be thinking about smart friction. When is the right time to ask a customer a question? When do you need to slow the customers down a little bit and get them to think about this transaction they're doing? Education also is critical, helping those college students, which could be an opportunity for you to gain a customer for life. Because we do see that people who get with a particular bank when they're in college are likely to stay with that bank for years to come. So being sure you have educational tools that are out there to help people be aware of the kind of fraud and scam activities that are going on and what it means to have your identity taken over as a mule. You thought you were getting $1,000 for a $100 bank account. But you didn't realize you were giving up your identity to somebody who was going to misuse it. So critical kind of opportunity. That's also, I think, an engagement opportunity. I've seen a few community banks and credit unions use social media that way by doing videos and things like that to engage their customers or reaching out to customers they have who are very engaged in social media and using them as influencers for their services and some of their resources. Really nice ideas there. And then I think it's critical to meet your customers where they are. Find out where your customers are engaging. I think that's probably why we've seen fintech organizations like Chime be so effective in opening new accounts. They are doing a good job of meeting those customers right in the channels that the customers are active in. So I think those are some of the, if I had a quick summary list, I think that's the best I could do, Travis.
Hey, Rob, appreciate that. So question number 3, a person asks, on the best practices slide, what tools do institutions have available from FRFS today that are already included? I think I'll take this if it's okay for the group. What I think they're asking is what products are included within the packages that they subscribe to today. The good thing is that, in the best practices slide, we discuss, from a prevention investigation, getting into the actual managing exceptions. One of the things that we try to do is, from a value add standpoint, is provide some of those services within your the connection that you subscribe into. I know many of you are already familiar with connections. We have Fedline Web, Fedline Advantage, Fedline Command, Fedline Direct. And the good thing is that many of the services that we discussed before are included in that base package. And I think that's our end goal at the end of the day is trying to get away as much as possible of those variable costs and adding those additional associated costs to our end user and stakeholders like yourselves, and really providing value through some fixed costs. So the good thing is that many of the services that I discussed are included within those packages, and I would encourage you, if you haven't already, if you have interest in some of those products and services, just to have a discussion with your account executive or relationship manager, and they can kind of walk you through which services are included or which services you can actually participate and leverage a la carte. But again, most of those services, those value adds, are included within the package. If not, we still build our services from a very cost-friendly perspective. At the end of the day, we're committed to cost recover, and we try to provide our services at a price to where we're able to cost recover, but at the same time add value and not to break the bank for some of our customers. And we hear some positive feedback in regards to some of those pricing. So I will move on to the next question. Hopefully that answered that question. Stacy, a question for you. Can you share a case study on how institutions are using the fraud classifier today? Say where mechanics, insights, benefits, any learnings to date. I want to see if you can share anything in regards to that.
Yeah, absolutely. So I would say there's a couple of different ways that it's being used. So we actually are using it with FedNow for the required fraud reporting. So it's been very helpful to give us insights on what folks are seeing. And then there's also, one of the large service providers just rolled it out within their fraud case management tool. So that will be extremely valuable in being able to see what institutions are seeing, but also across the network, what folks are seeing. And again, because they're using, the model and the descriptions and, classifying in a similar way, that will better help them be able to see what the fraud trends are.
All right, excellent. Thank you, Stacy. I appreciate that. So one more question, and I think, Stacy, this would be a good one for you. Um, can you share what's new from the scams work group with the audience today?
Sure, absolutely. So we actually have two work groups that are going on around scams. So the first is focused on a definition of scam and a classification model. So we released the definition back in the fall, and actually within the next month, so early June, we'll be releasing a classifier model. So similar to fraud classifier that I was going through, but really just focused on scams. So again, part of the feedback we heard from the industry is there was not a consistent method to classify scams. So the structure looks very similar to fraud classifier, but we're calling it scam classifier. And it also takes you through a series of questions based on the scenario to help you classify the scam type. So we're super excited about that. And again, hoping that folks can not only use that as an educational tool, so there'll be supporting documentation, but also to help bring some more consistency to the classification of scams. And the other group that we have going on is around information sharing as it relates to scam activity. So this group has been working for about a year to develop a recommendation on how to better share information to help mitigate scam activity. So super excited about that one as well. And that one is wrapping up at the end of June. And that recommendation will be coming out in late August, it looks like right now. So stay tuned for that. Lots of exciting work going on around scams from our group.
Perfect. Thank you, Stacy. Yeah, I agree with you. A lot of exciting work, and we appreciate the work that you are doing to kind of help the industry in regards to managing scams and fraud and better classifying and defining. So thank you. So moving to our last slide, hopefully this information has been valuable. Again, we appreciate the folks that have joined us today. We don't take for granted, and we appreciate the opportunity every time we get a chance to speak with you, to gain insights. And we learn from you as probably just as much as you learn from us. So certainly a partnership that we appreciate. But what I would like to do, if you're interested in the information that we shared today, just want to point out a couple of resources we have on FRB services. Not sure if you all have had the opportunity to go out and take a look at our Risk Management Resource Center, but a lot of really good information out there on that resource. You can gain access to some of the services we have, as well as some of the studies that Rob pointed to today. And then obviously we encourage you to leverage the relationship you have with your relationship manager. If you have any questions specific to one thing that was pointed out in the webinar today, we encourage you to have constant dialogue conversations with your relationship manager. So want to make sure I point out that. I want to thank both Stacy and Rob for joining us today and sharing those highlights. A lot of really good information. I know I've learned something today. Hopefully the audience has as well. I want to take a minute and pause and see if Rob, Stacy have any other closing statements before we end the webinar today. So I want to see if there's anything from Rob, Stacy.
I would just say thank you again for having me. And our website is fedpaymentsimprovement.org. So if you're looking for more information on fraud classifier, the work that we have done or are doing around scams, feel free to check us out there.
Yeah,
Thank you.
I'll add my thanks, Triandos. I appreciate everyone's time, and I appreciate your engagement through the survey. This slide, you should have received these slides about an hour before the call in your email. So if you want a copy of the slides for some reason, you should have them at this point. Feel free to reach out to me. My email address is there, and the link there is a bookings link. So if you want to schedule a few minutes to talk about some of these results and some of the other results that we've shared in the study that's published online, feel free to grab a little time, and be happy to take a little time to chat about it. And then I would encourage folks to reach out, like you said already, Triandos, to your relationship manager and find out more about the services Triandos shared with us. So thank you, audience, and thank you, Triandos and Stacy.
All right. Well, I hope everyone have a wonderful weekend. Happy Memorial Day to everyone. And I hope you have a wonderful rest of the day. Thank you.